in continuation, we have this transaction which happened between ABC Limited and DEF Limited. Okay, so on 3rd July 2018, ABC Limited sold an equipment to DEF. Okay, so when we are consolidating report, okay, for parent and subsidiary, those intragroup transactions should be eliminated. So this one is one of those intragroup transactions. So ABC sold that equipment to DEF at $120,000, but the original cost is $150,000 with accumulated depreciation $50,000, and then the remaining life is 4 years. Then 30th September 2018, DEF Limited sold inventory to ABC Limited at sale price of $60,000, but the original cost of that inventory to DEF is $50,000. Okay, so, and for the whole year, the remaining inventory for coming from DEF, okay, which they sold to ABC, ABC still holds 40%. And on 1st May 2019, DEF Limited declared dividend $50,000. The dividend include profit from 1st July to 31st December 2018. So our requirement is to prepare consolidation elimination entries for the year end 30th June 2019. Okay, so the first thing that you need to do is, because they mentioned about land with revalued as at the acquisition date, okay, there was an increase in the value of the land, so you have to record that increase first, $50,000, and then credit deferred tax liability, which is 30% of this, and then the remaining, of course, will be charged to revaluation surplus. So first, revalue, okay, the items that which needs to revalue, so that we can determine the fair value of identifiable net asset in calculating goodwill or gain on purchase or bargain purchase. So this is the next step. You have to eliminate the investment account which is under ABC Limited's account, and then we have to debit those items at equity section. Okay, so we will include now here the valuation surplus coming from the previous entry. Okay, notice we use the original amount. So at the date of acquisition, you have to eliminate. Okay. So we'll just assume for illustration purposes that we have not yet touched the income section. Okay. But it should be included. So when you're calculating, we have acquisition cost 1 million, and then fair value of identifiable net asset, okay, 885,000, the total of this, and then the difference will be charged to goodwill. For elimination entry of intragroup sale of fixed asset, okay, so we have $120,000 here as the proceeds from the sale of equipment, okay, which is paid by DEF to ABC Limited, and then $100,000 is the difference between $150,000 original cost of equipment less $50,000 for accumulated depreciation. You can see or maybe track back for to see the information, okay, or to verify the information so that you will know where we got the $100,000. That is the carrying amount. Okay, so the gain should be eliminated, $20,000 here. Okay, it was recorded previously in the accounting profit, but when we merge it, when we consolidate the report, we have to eliminate that. Okay, so we got it from the difference between these two. And then accumulated depreciation 50,000 is the original accumulated depreciation, okay, that we eliminated when we sold the equipment. So when ABC Limited sold the equipment, okay, they remove this $50,000. And on top will be the difference between these two items. Okay. Then afterwards, you have to determine the tax effect. Okay? The tax effect will be like this. Okay? $6,000 for deferred tax asset and then credit income tax expense. The reason why you credited income tax expense here is because when you eliminate gain, it reduces or decreases the accounting profit. So which means the income tax effect will be reduced also. To represent the reduced in income tax expense, which is the normal side is debit, we have to credit the income tax expense. And the debit here is deferred tax asset. How to calculate for that one? We have $20,000 here, which is the gain here, multiplied by 30%, the tax rate given in our illustration. Afterwards, you have to reinstate. We call it reinstate the depreciation or depreciation expense as if we didn't sold or the company didn't sold the equipment. Okay? So how to do that? Based on DF record, they purchased the equipment at $120,000. Remaining life is 4 years. Okay? So divide that one. This is the recorded depreciation per DEF, who is now the holder of the equipment. But for ABC, if he continued the depreciation, if that's why I'm using the term, if he's continuing the depreciation, the recorded depreciation should only be $25,000. Okay? Only $25,000. So the difference between these two will be $5,000. That is the excess depreciation when you consolidate the report. Again, as if ABC didn't sold the equipment. Okay? So what will be the journal entry? Debit accumulated depreciation $5,000 and then credit depreciation expense $5,000. Okay? So this is the excess. You have to eliminate it at expense. Okay? To reduce the expense, credit the expense. Then if you are crediting the expense, which means it will reduce the amount of depreciation, it will increase the income. When income increases, what will happen? It will increase the income tax. The question is how much? Of course, you have to determine how much you decreases the expense, in this case the depreciation expense, and then multiply it by 30%. So debit income tax expense and then credit deferred tax asset. Okay? Okay, so the next elimination that we will do will be for elimination of intragroup sale of inventory. So in this case, DEF had sold inventory around $60,000, okay, to ABC. So in that case, we have to eliminate that sale as if the sale didn't happen. So we have to debit $60,000 and then credit $60,000 but for cost of sale. Okay. And then to determine the unrealized portion of the profit, we have to know how much the party sold the item and how much is the original cost. In this case, the original cost is $50,000 and then $60,000 will be the amount that the party had sold the item. Okay, so DEF had sold that $60,000 and but the original cost is $50,000. If in case that the item didn't come out of the economic entity, okay, the $10,000, which is the difference here, will be unrealized, okay, or unrealized profit. But in this case, only 40% remains within the entity. So we will only determine, or we will only say the unrealized portion of the 10,000 will be 4,000, equivalent of the 40% remaining inside the entity. And then if you are unrealizing a profit, it will affect the income. Okay, just like what I've said in fixed asset, sale of fixed asset. Okay, so in this case, if you are unrealizing $4,000, it will reduce the income. So what will happen is it will also reduce the income tax expense. So we credited income tax expense here, 1,200. Okay, which is 30% of the 4,000. The debit, of course, is deferred tax asset. And the last one is elimination of intergroup dividends. Okay, so the dividends declared was what we call post-acquisition profit. When you say post-acquisition profit, it was earned after the acquisition, okay, made by the company. So to do that, eliminate first the dividend proposed. So the journal entry will be debit dividend payable, and then the credit dividend declared 50,000. Okay. And then debit dividend income and debit dividend receivable 50,000. Okay, so this is how you eliminate the post-acquisition or dividends coming from post-acquisition profit. Thank you for watching the video. I hope you learned something. The slides will be available through the link. Okay, so thank you.